Hi, and thank you for joining us today for our Precious Metals Royalty Conference. Well, gold is up over 50% on the year and silver is up over 100%. And for investors, there's many ways to benefit from these moves in gold and silver. You can buy physical gold or silver bullion. You can buy a gold or silver producer, or you can buy a royalty or streaming company. Royalties and streams provide exposure to gold and silver without the risks associated with a mining company like geological risk, operational risk, or jurisdictional risk. But the biggest advantage of a royalty company is their free optionality on its portfolio of royalties and streams. The best example of this optionality feature is Franco-Nevada's Goldstrike royalty, which was acquired for $2 million in 1985. And here we are today, and that one royalty has generated over $1 billion in cash flow for Franco-Nevada. So keep in mind, when you listen to our company presenters today, one of them might have another Goldstrike. Our conference begins with a discussion with investor Rick Rule, founder of Rule Investment Media, followed by David Cole of Elemental Royalty, David Garofalo of Gold Royalties, Sheldon Vanderkooy of Triple Flag Precious Metals, Dan O'Flaherty of Versamet Royalties, and we conclude with Randy Smallwood of Wheaton Precious Metals. As a reminder, we have an open chat on the right-hand side of your screen, so feel free to say hello or make a comment or ask a question. We will also be running polls throughout the conference to get your views on gold, silver, and the markets in general, so keep an eye out for those. If you can't watch this conference in its entirety, you can check it out anytime on our YouTube channel, Bloor Street Capital, and you can also follow us on Spotify and Apple Podcast. I hope you enjoy the conference. Rick, thank you very much for joining us today. How are things in the great state of Washington?
It's great to be back, James. As you know, I've been on the road. In direct answer to the question, it's gray and wet, but it's lovely to be home.
So why don't we start right there? You've been on the road for the last 5 weeks, visiting investors all through Europe. You've been to many conferences. Why don't you give us a sense of what people are saying and how would you characterize the mood of investors over in Europe right now when it comes to precious metals?
Oh, I should footnote that I started in New Orleans, so I started in this hemisphere. Then, of course, did Switzerland and Germany, and then the two conferences in Great Britain. Obviously, $50+ silver and $4,100, $4,200 plus gold made for a really ebullient conference season. The European conferences are showing record attendance. I did both the Zurich conference and then a conference in Frankfurt, and then two in Great Britain. The second Great Britain conference was the Northern Miner Conference, which is primarily retail, but the rest were primarily institutional. And I have to say the turnout among institutional investors, particularly in Zurich, was astonishing. And I would say ebullient. And I need to say, perhaps a bit of bias here, but particularly on the gold equities, you got to feel pretty good about them in the near term. I've been reading the analyst report coming out of the Bay Street banks, and they're all using $3,000, $3,200 gold assumptions. It's pretty difficult not to beat your quarter if the quarter estimate is predicated on 32 and you're selling the stuff for 42. I suspect the near quarter beats are going to be pretty extravagant and fairly ubiquitous through the sector. That is the stuff that bull markets are made of.
So you said the mood's pretty good overall, and you're surprised by the number of people showing up these conferences. You've been through many cycles, and I'm just kind of curious, like, if I was to use a baseball analogy, where do you think we are? What inning are we in?
I think we're still early on, but I need to say, for the junior part of the market, I think it might be a little ahead of itself. Normally, these markets go from the bullion to the senior producers, to the intermediate producers, down to the juniors. And the financing window for the juniors has been wide open. And the juniors got spectacular reception, both in Frankfurt and London. So it wouldn't surprise me to see the juniors go sideways and catch a breath. But, precious metals bull markets are led by gold. And as you and I have talked about on your show before, my belief is that the gold price is pretty inextricably linked to the purchasing power of the US dollar. And I hate as an American to say this, but I think the US dollar loses in an absolute sense 75% of its purchasing power over the next 10 years. If that's true, and gold merely maintains its purchasing power, that suggests that gold could run threefold or fourfold for the rest of the decade. Um, you know, there's precedent for this. In the decade of the 1970s, the gold price, the dollar lost 75% of its purchasing power, and the gold price ran, what, 28-fold, 29-fold? I'm not saying it's going to run 20 or 29-fold from here, by the way, but it wouldn't surprise me at all in nominal terms, US dollar terms, to see the gold price go up 3 or 4-fold as the US dollar declines. That means, if it's true, that there's plenty of room left in silver, which is beginning to play very dramatic catch up, and lots of room too in the equity space. I suspect, led by the seniors, for the reason I just described, the earning beats I think are going to be extravagant, given the gold prices assumptions that Bay Street is using, and people like pleasant surprises.
So you bring up a very interesting point, and that is the money supply or the printing of money. And this is one thing a lot of people don't understand. If you look at the money supply as measured by M2 in the last 5 years, back in January of 2020, before all the craziness started, the M2 was at $15.4 trillion. And here we are 5 years later, and it's over $22 trillion. That's an increase of 42%. So to your point, this is what's happening. The cost of every good, service, and asset has gone up 30, 40, 50% in the last 5 years. And it's all because of this excessive money printing.
I think that's right. And I also think, and this is a subtle point, but it's important for your audience to get it. Savers right now, US dollar savers, Canadian dollar savers too, for that matter, need to diversify out of long bonds. The stated rate of inflation, the CPI stated rate of inflation, is a joke. We've talked about this before. It doesn't include food or fuel. You know, what use is an index? It doesn't include lunch. And it doesn't include tax either. I believe that the rate of inflation on the basket of goods and services that I buy in either country is escalating at 8 or 9% compounded. The problem is if you're borrowing, or if you're saving in something like a U.S. Treasury, 10-year Treasury, getting paid 4.2 in a currency that's depreciating by 8, you're losing 3.8 a year compounded. You do that for 10 years, you're off 40% of your purchasing power. We saw this happen in the beginning of the decade of the 70s. I remember it took a while for the impact of inflation to hit the household, but when it did, interest in gold skyrocketed. And I'm sorry to say I believe past this prologue. By the way, not just on my side of the 49th, your side too.
Oh, believe me, I'm feeling the pain every week. I go for groceries. I don't care if you go to Walmart, Costco, Whole Foods, wherever. Right. I'm shocked by the amount of money I have to pay for food now. It's just crazy. And this is happening everywhere. It's just not here. But the other thing I think that's worth mentioning is that the government, you talk about CPI. Well, the government just announced they're not going to release CPI numbers for the month of October. They're not releasing the unemployment number or the non-farms for the month of October. So we have no idea where the hell these numbers are. And even the non-farms for the month of November, they said they're going to release them on December the 16th, which is much later. They typically do it the first Friday of every month. But what's your take on the unemployment numbers? Is this like, I guess, a hint of what might be coming? Like, do you think we're going to see a big increase in the CPI and also the unemployment number?
I think they'll continue to manage the CPI. And I think that most people will believe them. Most people don't take the time, like you and I do, to budget and look at what they're paying for things. The United States, I can't speak to Canada, but the United States is an interesting economy. There are millions of people whose educational levels don't provide them the ability to generate enough utility to earn a living on the wages that employers can afford to pay for them. On the other hand, highly skilled employees are in desperately short supply. There isn't an awful lot that the government can do about that in the near term. I would argue, perhaps, that they needed to begin educational reform something like 3 decades ago. But 30 years late is a problem. The number that they will release in the United States pretty quickly, I think, will be a lower bank rate. Unfortunately, despite the fact that the economy is fairly strong, our president and all of our elected politicians, for that matter, save three, believe that the interest rate should be lower. It makes sense from a politician's point of view to do this. Lower interest rates are a subsidy to spenders and a benefit to savers. And there's more spenders in society than there are savers. Our president now has decided to buy our votes with our own money. He's going to send out a tariff rebate check, as I understand it, somewhere between $1,000 and $2,000. He's going to give us a check drawn against a bank account that's now $38 trillion overdrawn. You can tell how I feel about this. Those are numbers that they will release. A $2,000 bribe or $1,000 bribe, they haven't decided yet, with our own money, or rather with our children and grandchildren's money. And of course, lower interest rates in an economy that everybody suggests is strong. This doesn't augur well unless you happen to be long gold, in which case it augurs very, very, very well. Lower interest rates penalize savers, they benefit spenders, they make the negative real interest rate, the difference between the inflation rate and the yield on savings, even more disadvantageous. And I think they stimulate even more disintermediation from long bonds, that is bonds greater than 10 years, to gold.
So if I understand you correctly, you're concerned with cutting rates in this strong economy, which is growing at 3% plus. You believe it's going to result in a much stronger economy and therefore higher inflation.
Not a stronger economy, but it is going to get. It may yield a stronger economy. It'll certainly probably yield higher equity prices. It may, in the near term, be very good for bond prices. You know, what bond yield falls, that means the yields on existing bonds are worth more. But the idea that the interest rate is already substantially below the real rate of inflation sends a very bad signal to the economy. You are supposed to use liquidity in a bad economy, not use liquidity in a good economy. The Keynesian precept was always that you save in good times and you spend in bad times. It would appear that since the death of Keynes, we've only had bad times, given the response by the policymakers to Keynesianism.
All right, so we talked about a lot of the reasons what's really driving the gold price. And I want to touch on a couple of more elements here and get your views. The central banks have been ongoing buyers, especially since Russia invaded Ukraine. They stepped in and now they're buying 25 to 30% of annual gold production, according to the World Gold Council. But one of the things that's really interesting that we saw in 2025 is that we have a new non-traditional buyer of gold, and that is Tether. And just for the benefit of our viewers, Tether is the world's largest stablecoin provider. They currently hold $170 billion in USDT. And these dollars are invested in U.S. Treasuries, and from that they get $6 to $7 billion worth of interest, and they're deploying that money into the gold market. And this has also been a big, I guess you could say, propellant for taking the price of gold higher. But what are your thoughts on having this new entry or this new participant into the gold market?
I love it. I love it because with the introduction of a stable coin, gold becomes closer to being both a medium of exchange and a store of value. Right now, when people buy physical gold, they're paying a 2.5–3% buy-side commission. When they sell it, they're paying a 2.5–3% sell-side commission, which means that the transaction costs are between 6 and 7%. That's pretty high for money. With a stable coin, ultimately, you will be able to go to Starbucks and use your gold credit to buy a cup of coffee. Starbucks will be able to aggregate those micro credits and surrender them to Tether for a fully redeemable piece of gold. The transaction costs are a fraction of what regular transaction costs are. There is concern among gold holders that Tether may or may not be fully reserved with their gold. There is a resistance among some retail gold holders and all of the central banks to hold a piece of paper, be it a coin or anything else, rather than holding physical gold. I get all that. There are a bunch of financial buyers out there, and there are a bunch of people like myself who would like to use gold for liquidity, who would like to buy and sell goods and services in gold, but they'd like to do it for lower transaction costs. And Tether offers that. It's worth noting, and you did, that in addition to being the largest buyers of gold, Tether's the largest buyers of U.S. treasuries on the planet. This is, I think, the financialization of the blockchain, which is to say anything that can be turned into a uniform coin and used as a medium of exchange will be. I suspect 10 years from now, you will be able to use an S&P 500 coin at your grocery store or at Starbucks. I just personally happen to prefer gold.
And Tether has also been a large buyer of precious metal royalty companies. And I know you can't speak for Tether, but I know you have also been a large buyer of royalties and streamers over the years. And maybe you can tell us the reasons why you have such an affinity for royalty companies.
I think it's the best basic business in the mining business. Certainly, the royalty and streaming companies, ironically, are so efficient that in a rip-roaring bull market, their stocks underperform. Inefficient producers have lower margins, and so an increase in the price increases their margin more. I'm okay with that. The royalty and streaming companies take away most of my downside. If you take away most of my downside, you can have some of my upside. I'm good for that. You know, with a royalty company, your gross is your net, basically. You don't get a sustaining capital bill. You don't get a new projects capital bill. You don't get an operating bill. All you get at the end of the quarter is a bunch of gold, which you sell and turn into cash. Pretty good deal. The streaming business is a bit more complex. You have to pay for that stream and amortize it over time. And some streams have an exercise price at half market or some other number. But the truth is, these are predictable, high margin businesses. And they're businesses that, because they don't have to operate mines, are extremely efficient from a general and administrative expense point of view. The last time I looked, as an example, Franco-Nevada had a management expense ratio, what we would call a management expense ratio in the funds business, of 11 basis points. It costs 0.11% of their revenues to run that business. That includes the receptionist. That's astonishing. Absolutely astonishing. So for your audience, for the part of your audience that isn't prepared to spend 25 or 30 hours a month studying the individual securities in their gold holdings, it is possible to construct an entire portfolio out of royalty and streaming companies. And while it might underperform in the hottest of all bull markets, as an all-season investment in precious metals, you can't do better.
And Rick, quite often we see a big range in terms of valuation. There's always a big range on how these names trade. So a large name like Franco-Nevada might be trading at 2 times or 2.5 times NAV. But then you get some smaller names and they might be trading at NAV or below NAV. As an investor, how do you value that?
NAV is almost always understated. Our NAV models use a discount. Bay Street uses 5%, I use 10%. What that does is it unduly penalizes cash flow that occurs 8 or 10 years out. If you're Franco-Nevada and Wheaton Precious and you have 35 years of reserves on the book, your NAV calculation doesn't pay you very much at all for anything that happens after year 8. But I guarantee it's going to come in handy. The second thing with regards to the big royalty companies is they have very high quality deposits. These high-quality deposits are usually put in production when there is enough reserve to justify the capital expense, meaning there's a lot of low-hanging fruit left in exploration. So with the royalty and streaming companies, the big ones, you get this wonderful exploration upside around these big deposits. Franco-Nevada, every year at no cost to themselves, more than replaces their reserves without buying any new reserves based on exploration work that the companies that they own the royalty and streams under are doing it. Franco doesn't pay for that, but it's it's lovely to see reserve replacement in excess of 100% at no exploration cost to Franco shareholders.
So those are many of the benefits associated with royalties. Now, before we start talking about silver, I got to get your target price on gold. I saw a lot of U.S. dealers. I can't believe how aggressive they've been with their target prices. But Bank of America, I think they're at $5,000 now for 2026. Goldman Sachs, I think they were at 4,900. And I even saw Jamie Dimon came out. I don't know if you saw this interview, but he said it's for the first time in his career, it's semi-rational to hold some gold in your portfolio. And he said in this current economic environment, gold could easily go to $5,000 or $10,000. I think he said by the end of the decade. But what are your thoughts? Where does gold go here by the end of the decade?
Well, irrespective of what Bay Street and Wall Street said, I mean, you're an old Bay Street guy. These guys are talking their books, right? I mean, they didn't talk about bank gold before because there was no fee in it. Now there's a fee, so all of a sudden they're bulls. Let's leave that aside. I've been on record as saying, and I'm not going to give you a specific price because I'm not dumb enough to do that. But if the U.S. dollar loses 75% of its purchasing power, and I don't know how it can't, I suspect that gold keeps pace, which means over the course of 10 years from here, I think gold is up threefold, fourfold. Maybe it's only up 2.5. Can you live with 250% in 10 years? I sure can.
Well, Rick, once again, thank you.
Always a pleasure. Thank you.
Hi, I hope you're enjoying the conference. Did you know that 80% of our viewers are not subscribers to our channel, Bloor Street Capital? So please hit the subscribe button and also hit that thumbs up button. Thank you for your support. David, thank you very much for joining us today. You and your team have been very busy here in the last few months. You recently completed a very large merger. You also completed a new royalty, and you also started trading on the NASDAQ. So we have a lot to discuss. And why don't we begin with the merger? For those who aren't familiar with Elemental and the back history, why don't you just tell us a little bit about the merger and what the reasoning was for doing it?
James, first of all, thanks a lot for having us on. Our pleasure. And certainly it's my pleasure to talk about Elemental Royalty and the merger of these two great companies. I'm particularly pleased to bring together the portfolios and the physical assets, and even more importantly, to bring together the team. So just for everyone's edification, EMX Royalty Corporation has been around for well over 2 decades and has built a phenomenal portfolio, was merged with Elemental Altus Royalties, who also have built a fabulous portfolio. Both companies having had a track record of nice success of coming up from extraordinarily small companies to large junior companies, if you will, have now come together to form a emerging mid-tier royalty company. And very importantly on this topic is the synergies of the culture of the teams. So EMX, which is where I came from, and I'm the founder and CEO of EMX, now the CEO of Elemental. We were always known for our top shelf technical talent, economic geology, engineering, and our entrepreneurial spirit. And that's worked well for us. The Elemental guys are well known for being young, sharp, intelligent bankers, finance guys, with a long track record of working successfully in the mining sector. So bringing together these two teams is something that Fred Bell, the CEO of Elemental, and I have believed was the right thing to do now for nearly 2 years. And we've been talking about that. Previously, we syndicated royalty purchases together. There were a number of opportunities that we vetted together and failed. So we've been working collectively and as friendly competitors now for a while. The catalyst for bringing this together now is the fact that Tether, led by Juan Sartori as the chief investment officer for Tether, came in and bought a large stake in Elemental. Juan spoke to Fred and said, how do we gain scale to this business? And Fred said, we need to call Dave Cole. So I flew to New York, I met him, and we very quickly agreed that it was the right time to bring these companies together. That's been actuated, and we're now right at $1 billion market cap. Part and parcel to that merger Tether put in an additional 100 million USD in capital into the merge co simultaneously. And so that makes us right at $1 billion market cap. We have no debt. We've recently purchased a couple more royalties as well. And we're sitting with nearly 50 million USD in cash and gold in the bank. And we're in the process of putting together a larger expanded credit facility. The credit facility that we had prior to the merger between the two companies was roughly 85 million. I expect that to go up by 50% or more, which you would expect. And the banks are keen to work with us. I would also like to point out that the key strategic shareholder, one of the key strategic shareholders in EMX, was Franco-Nevada. And Franco-Nevada was a joint venture partner and also held EMX's long-term debt. That debt has been paid off with the cash infusion from Tether. The joint venture with Franco-Nevada to look for new royalty financing remains in place. And Franco remains a shareholder and voted for the transaction. So we're very pleased to have the support of Franco-Nevada and very pleased to have the support of one of the most profitable and largest private companies in the world, Tether. And that is Tether stablecoin for those people that were not familiar with that name. And they are currently profiting nearly $20 billion a year and looking for ways to reallocate those profits. And gold royalties is one of the ways that they're doing that. So we're in a situation today that's enviable, where we have the financial backing of Franco-Nevada, arguably one of the best long-term mining investments in the mining industry, and Tether, one of the most financially successful private companies in the world. And so this is a very nice combination. And that matches well the combination of the royalty portfolio that we've brought together, which has some nice critical mass and some key cornerstone assets within that.
And David, just because we're on the topic of Tether, you did mention they're the largest provider of stable coins in the world.
Yes, they are.
I believe the money that was invested in the stable coins is invested in treasuries, and I think I read they're the 17th largest holder of U.S. treasuries in the world. Is that correct?
So I've heard 6th largest, 17th. I mean, they own a lot of T-bills. And you're right, it's a phenomenal business model, and hats off to them. They sell a token for $1 in order to back the value of that and make it stable. They buy T-bills. So the T-bills back the USD stablecoin. The T-bills pay a coupon rate, and the coins do not. So that's where they reap their profits from. Stable coins are used extensively now as a very fluent way to conduct transaction internationally. They're used by currency traders, commodity traders, and extensively in developing countries where people have poor access to banks or banking laws are cumbersome or expensive. And so people are adopting USD stable as a way to transact globally efficiently. And the leader in this technology and the leader of this banking disruptive methodology of conducting commerce is Tether.
And David, as you mentioned, they're using the proceeds from the interest payments from the U.S. Treasuries to invest in gold bullion and also
they're also
royalty
buying
companies.
gold bullion.
But why?
Well, I guess if I was making $20 billion a year, I'd probably want to buy a lot of gold too. And just to quantify that for the listeners, and I'll say it a couple of times because it's a shocking number. It's a truly shocking number. They are now buying, and this is public information, 3 metric tons of physical gold metal a week. They are storing these 3 metric tons of augmented purchases per week in bunkers, including bunkers in Switzerland guarded by the Swiss Army. They are doing this for 2 reasons, as it has been explained to me. I'm not a Tether person, but they've, of course, told me and allowed me to tell you this, and this is information you can do your own research work on. 1, as an investment and a store of value, they believe in gold, as we all should. And 2, they have started the stable gold coin, where 1 token is created. That token is backed by physical gold in the vault, in the bunker, in Switzerland. And then just like the USD stable, this stable coin can be used as transactions, facilitating commerce globally. They believe, they Tether, are of the opinion that this will be disruptive to the banking industry as more and more people adopt the stable coin and specifically the stable gold coin.
It's very interesting to see these non-traditional sources of capital entering the gold sector.
It's fascinating, and we're delighted to be at the confluence of the crypto world and the hard asset world, and to have them as capital partners. And that sounds great and wonderful. Our job doesn't change much. We're here to allocate capital to expose ourselves to more prospective mineral rights, and the best way to be exposed to the ever augmenting value of prospective mineral rights is royalties.
That's a great overview. Thank you. And we should move on now. I want to ask you about some of your assets. Before we do that, I did mention that you're trading on the NASDAQ now. That's going to create a lot of exposure, especially for U.S. investors. What is the symbol on the NASDAQ?
Oh, it's ELE, right? And our ticker symbol on NASDAQ is ELE, and the ticker symbol in Toronto is ELE. And I joke that we should have named the company ELE Royalty, but because of course that's what we did at EMX. It was EMX and our ticker symbol was EMX, but Elemental Royalty is a great name. I'm happy with that. Fred loves it, of course, because that was the original name of the company he founded. And on the note of Fred, I want to say it's a pleasure to work with him.
Yeah, we'll have to get him on the show sometime. So let's talk about some of your assets. And I want to look at the assets, the ones that are really going to contribute to growth in the future. And the first one I want to ask you about is Timok. It's a copper gold mine located in Serbia. And I love these big copper mines because of the long mine life. But tell us about this asset and what it's going to mean to Elemental.
Yeah, it's a company maker. I feel extraordinarily fortunate to have exposure in the Timok magmatic complex, which is Europe's largest historic copper and gold producing region, and the site of one of the largest ongoing copper gold development stories in the world today. And the geology there, it's on the Tethyan metallogenic belt, which is well known for its endowment. And Zijin is the operator there. There are now 4 ore deposits that have been found within one of our royalty footprints. We have several royalty licenses with royalties on them within the district. And those 4 deposits include the 2 upper zones at Timok, which are very high grade, that are now producing at the rate of 15,000 tons per day, ramped up from initially 10,000 tons per day. And that's paying already to us and has been paying for a few years now, currently paying around $6 million per annum at that rate. Last quarter was 1.7x million. We expect that, based upon Zijin's public disclosure, for that to continue from the upper zones for about 13 more years. Whilst they're mining the upper zones, they're actively doing the development work on the truly gargantuan lower zone. The lower zone, which had another 250 million tons of resource added last year from further drilling, continues to grow, is now disclosed at 2.5 billion tons at close to 1% copper equivalent. I believe it's 0.87% copper and 0.16 grams per ton gold. So it's a truly gargantuan deposit. Zijin's stated plan there on the lower zone is to initiate production within the next couple of years on an incremental basis, and then ramp up to 125,000 tons per day of production in a new mill, which has already started construction. And at that rate, at the shocking rate of 125,000 tons per day from the first block cave cell, they expect and have published a 66-year mine life. So your comment, James, about long-lived assets, I mean, this is one. And so if that's not exciting enough, then there's a whole new deposit that is being found within our royalty footprint, 7 kilometers to the southeast, which they term the MG zone. The MG zone has about a dozen drill rigs still turning on the surface. And the maiden resource put out by Zijin in their last annual report last March is 150 million tons of 1.87% copper, so very high grade, and 0.61 grams per ton gold. so north of 2% equivalent. And we're just delighted to have yet another ore deposit found within our footprint there. Zijin's not made any statements with respect to timing of that to go into production. That would be immature. It's a brand new discovery. They don't have any idea how big it is yet. And truly a company making asset. The analysts, who I believe are still getting their arms wrapped around the magnitude of the discovery here, or discoveries, they put a average analyst consensus value on this net asset value well over $200 million. I'd like to point out that our fully loaded original cost of this royalty was 200,000 Canadian dollars. And this speaks spades to the concept of discovery optionality. And also it speaks to our ability to be able to identify prospective mineral rights and gain exposure to them through royalty ownership, which is what we do.
I love the fact that you brought up that you paid $200,000 for this royalty, and you may or may not know this, but how much has it paid you so far?
Yeah, it's paid 18.4, I think, so far, USD. And like I said, with the analyst consensus NAV, which I think is shy, actually, is over 200 million USD. Yeah. Just last year, they added the MG zone discovery, 150 million tons of over 2%. And they added 250 million tons to the lower zone at about 1%. So, I mean, this story is a long ways from being over.
I want to move on now and ask you about another copper mine, and that is Caserones. This one is located in the country of Chile, and the operators, the Lundin family. Mm-hmm. Tell us about this asset and what it's going to mean to Elemental.
Yeah, and this is a good example of, prior to the merger, Elemental Altus working with EMX Royalty. We syndicated the purchase of this with both companies' view to gain scale to our business, add cash flowing assets at the top of the pyramid, and it's been a very successful investment. This is a copper and molybdenum porphyry deposit, and Lundin Mining Corporation has come in and brought 75% from JX Nippon. JX Nippon was doing a good job. Lundin's doing an even better job. And what I like most about owning royalties, as you already know, is discovery optionality. Lundin last year, in 24, put in $14 million into exploration work and had some nice, interesting intercepts. And this year they're putting in $22 million, and they're bragging about the high-grade breccia zones that they are finding beneath the known mineral at Caserones proper from in-pit drilling. And there's no better place to find more mineral than inside the mine from the royalty holder's perspective. And then in addition to that, there's the whole new porphyry system that they are now delineating immediately next door called Angelica. Both of these deposits are fully within a very large royalty footprint. The royalty footprint here is substantial in size. We've compared it in size to the entire sprawl of the city of Phoenix in Arizona. It's rather astonishing. And there's a dozen quality copper prospects within our footprint, and the potential for that to continue to have discovery success it seems imminent at this point in time. So we're very pleased. And in addition, Lundin's doing a good job of increasing capacity at that mine up to nameplate capacity, which they had not achieved previously. So that's good. So we're getting a little production uptick. We're getting much more discovery on the property, and of course, a much higher copper price.
So we spoke about two copper mines. Now I want to ask you about two gold mines, and the first one being Karlawinda. It's a gold mine located in Australia, one of the greatest mining jurisdictions in the world. Tell us about this asset. So,
we like to point out, and particularly Fred, when you interview Fred, he likes to point out that these four cornerstone assets, the two copper ones we've discussed, and then Laverton and Karlawinda in Australia, are the four assets that we believe are assets that could easily be within a major's portfolio and create the foundation for us ultimately becoming a major royalty company. And at Karlawinda, we've seen continued and currently ongoing production increase, in addition to exploration work, testing that zone down dip and adding resources. This is an asset that will produce for for decades into the future, and it's a cornerstone gold asset. It's interesting that the first two assets we talked about were copper, one copper gold, and one copper and molybdenum. Um, I'll make note of the fact that 67% of our current income comes from precious metals. And I personally am a big believer in the diversification, and I think copper and gold complement themselves very nicely in a diversified portfolio. But we do intend on remaining always over 50% precious metals top line revenue. The and then, well, yeah, that answers the question about Carlowenda. It's a great gold deposit. Making money in Australia is the summary.
So let's move on to the newest acquisition, and that's Laverton. Tell us about this asset, which is also a gold mine in Australia.
Yes, and Laverton is not yet paying, but it will in the very near future. And it's a substantial district with, I believe, over 100 million ounces of historic production from many mines within that orogenic gold camp. And it's one of the big camps in Australia. And we're delighted to have increased our royalty footprint there. And hats off to the team for having found this royalty and being able to purchase this royalty without going through a sales process. And so we used to have a 2% royalty over a portion of the district. We added another 2%, some of which was applicable to the ground where we already had to, and some on some new ground. So now we have a mixture of 2 and 4% royalty scattered through the district on some very nice deposits and very nice prospects. And Fred in particular is very excited about the upside here with immediate, within the next year or two, production initiation and production growth that we anticipate over the course of the next handful of years. And we believe that the discovery optionality potential here is immense.
So, Dave, I want to ask you about optionality now. You already spoke about this, and
this is one of my favorite topics. Yeah.
This is why I love royalties, because of this upside potential. And just to remind our viewers, on TMOC, you paid $200,000 for it, and it's already paid over $18 million, correct?
Yes, that's a fact.
So, what other assets in your portfolio that you think might have this kind of optionality?
Yeah, well, they all have optionality of different types. And let's talk about how optionality works, right? So once you acquire royalty over an asset, and you could do that organically the way we do with our royalty generation work, acquire stake mining claims, sell them, keep a royalty. We love to do that. Or whether you buy the royalty or that was created by somebody else, or whether you do a royalty financing to provide financing to a mining company to advance a deposit. All of those things end up resulting in you having this royalty, and then you're exposed to this concept of optionality. And the fascinating thing is that in many cases, when you buy a royalty, it's based upon the discounted cash flow analysis and traditional financial engineering that is done on the reserves and resources of the mine and the gold or copper price or the metal price of the day. And what we've seen over time is that gold and copper prices go up. Not always straight up, but there's that, and what we call that optionality. Optionality can go in both directions, but we are exposed to commodity price optionality by having royalties. We're also exposed to discovery optionality as geologists work these deposits, as they mine, learn more about the geology, learn more about the ore controls, and figure out how to follow those ore controls to find more deposits. That all is upside to the royalty holder at no cost to the royalty holder. So we're not paying for the exploration drill holes. We have a royalty. And then there's another aspect, a couple more aspects of this concept of optionality. One would be metallurgical optionality. When I was a young man on the Carlin Trend, I was told that there'll never be a mine that goes over 500 feet deep because at roughly 500 feet, the oxidation boundary stopped and you're in sulfidic ores, and sulfidic ores were not considered to be economic at that point in time. Well, guess what? Metallurgists figured out how to get the gold out of the refractory ores more efficiently than they could before. That is furthered by the higher gold price. And then another aspect of optionality is engineering optionality. I was also told as a young geologist on the Carlin Trend working for Newmont that there'd never be an underground mine on the Carlin Trend or even in most regions of Nevada for that matter, because the rock quality index was too low. Well, guess what? Their ingenious engineers figured out how to do it, right? They have better rock bolts or whatever technique they use. And so these things are multiplicative. So when Pierre Lassonde bought the Gold Strike royalty out of the Reno paper for 2 million Canadian dollars, it was on a small ratty deposit in the upper plate, which is the poor host rocks. And inevitably, they found gold in the better host rocks at depth. The metallurgists figured out how to extract gold out of previously unextractable ores, what we call refractory ores. And then furthermore, the engineers figured out how to mine bigger, deeper pits and figured out how to go underground. And the price of gold did a 10x. So all of that multiplies together, and that royalty for Franco, as a company making transaction for them, has now paid over $1 billion and is still paying. And our Timok royalty will be of this ilk as well. That's the type of return I expect to see from Timok. Paid $200,000 and make billions. And that's why you want to be in the royalty business. It's why you want to own individual royalties and portfolio of royalties and royalty companies.
And Dave, you made mention of another very vital fact with royalty companies is that all your partners are spending millions of dollars on exploration, but you don't have to put up one penny. How much are your partners collectively spending on exploration?
Yeah, we just added it up, in fact, for the combined company, now the new Elemental, and it's nicely over $100 million that our partners spend in exploration drilling on our 200 royalties in 20 countries at no cost to us. And that creates this wonderful thing called discovery optionality.
And once again, there's a whole lot of potential for upside associated with that.
Occasionally mines go south, right? You know, it can go both ways, but that's the nice thing about having a portfolio, right? You're helping to alleviate that risk through the portfolio effect.
So I want to move on now and talk about valuation. And when you look at the bigger names like Franco, like Wheaton, they're trading at over 2 times NAV. Mm-hmm. And Elemental is trading significantly below that. But what will you and your team do in the coming months to try to close that valuation gap?
Well, we're here talking to you today, James. That's a good start. And, ever since we got this merger complete and particularly since we got the NASDAQ listing, I've spent a lot of time on virtual and real investor shows, meeting folks and talking to people, and bigger banks than ever previously wanted to speak to us now want to talk to us. And we're getting coverage from banks where we didn't have coverage previously. And in the royalty business, scale matters. So the larger royalty companies, as you pointed out, trade at a higher PNAV. That's the ratio of your net asset value per share relative to the price per share. And historically, Elemental and EMX were trading well below 1. And now we're trading close to 1 based on analyst consensus, not based on our own internal analysis. Whilst our competitors in the mid-tier space are trading 1.5 to 1.9, maybe 2 times NAV. And then the major 3 or 4 big guys, they're trading at well above 2 or even higher. And this is our opportunity. And I want to say that from a fiduciary responsibility standpoint and a value standpoint, my job is to create more net asset value per share. And that's what we've focused on for 20 years. And when you look at our net asset value per share on a chart, and this is the case for both companies and of course for the combined company, it's up and to the right. Right? Our net asset value per share has been going up for years. That's a measurement of how good of a job we're doing and how good of a business model this is. Here's the interesting thing. Our net asset value per share is going up, and our PNAV is going up, or it will go up, because now we're a bigger company, so we've gained that scale, so we're deserving of a higher PNAV. Those two are multiplicative. And then you want to pour fuel on the fire. We now qualify to be entered into a number of different stock indices. And prior and as of today, there's none of our stock in any index. The bankers have told us to expect between 10 and 18% of our issued and outstanding share capital to be gobbled up by the various indices of which we will likely qualify over the course of the forthcoming 12 months. So here I have a situation where NAV per share is increasing because of discovery and increasing commodity price. PNAV is increasing because of scale, and indexes have to buy us. It's a very special situation.
Dave, as we wrap up, what can shareholders and investors expect in terms of news flow in the first half of 2026 from Elemental?
I think that we're going to see solid returns from our existing operations thanks to higher commodity prices. And as those filter through the models that the banks have on us, we should all see our NAV numbers going up, and NAV going up on a per share basis, which is something I like to emphasize. And the team, it's not just the static as the portfolio is today, although as the portfolio is today is wonderful. It's going to perform exceptionally well. But this team is going to add to that portfolio through our royalty generation activities, through our royalty purchasing activities, and I'm hopeful that we could do some nice royalty financings to augment that as well.
Well, Dave, this has been a great overview and a great update. I want to thank you very much for spending time with us today.
Absolutely, my pleasure. And we're here to answer questions. So everyone watching this, feel free to reach out to us. Thank you.
Once again, thank you. Hi, did you know that we're on Spotify and Apple Podcasts? So now you can listen to us on Spotify or Apple and listen and learn when you're stuck in traffic on the 401 in Toronto, the I-5 in LA, or the I-95 in New York. Thank you for your support. David, thank you very much for joining us today. How are things in Vancouver?
Everything's great, thanks, and looking forward to the holidays.
So 2025 was a transformative year for Gold Royalty for many respects, and the company started generating free cash flow. You paid off a lot of debt, and you recently announced a new acquisition of a new royalty, and I want to touch on all of these points. But before we do that, why don't we just start with a brief overview of the company for those who might not be familiar with it?
Yeah, it's still a relatively young company. We IPO'd back in March of 2021, initially with 18 royalties in the portfolio, none of them cash flowing, significant mineral endowment underlying those royalties. And over the course of the last several years, we've diversified immensely. We've added over 240 new royalties into the portfolio through a combination of M&A, third-party royalty acquisition, project financing, and royalty generation. We really do all platforms extremely well, and that's unique in terms of the value proposition we offer relative to our peers in the space. So today, we're in a position where we have 8 cash flowing royalties, 14 in various stages of development and construction, and we have 360% growth in gold equivalent ounces attributable to our royalties over the next 5 years, generating positive free cash flow this year and growing exponentially in our free cash flow generation over that same 5-year period.
So let's talk about your newest acquisition, and that's Pedra Branca. Did I pronounce that right?
You did, in Brazil, yeah.
And it's a copper gold mine in Brazil. Provided an overview of this transaction, and what exactly was it about this asset that made you want to acquire it?
Well, the operator first, BHP. BHP's been operating the asset. Oz Minerals built it back in 2020. BHP announced the sale of the asset to Corex, a large diversified conglomerate, many multi-billion dollars in size with many verticals, and mining is one of their many verticals. And so that means a renewed effort in terms of optimizing that asset with capital and management intention. But it is a long life deposit, copper gold. It's a 25% gold royalty, a 2% copper royalty on an asset that has at least 15 years of reserve life ahead of it. Generated about 3,000 gold equivalent ounces to BlackRock's account last year. BlackRock was the previous owner before they sold it to us. And that means that would generate at current metal prices well over $12 million of incremental revenue to us. And that falls right to the bottom line because there's no costs associated with it. It's an NSR, so a top line royalty. And that only adds to what's already an impressive growth profile and free cash flow in 2026. By our estimation, it's about 10% accretive to us on net asset value per share on a consensus basis. It's about 45% accretive on cash flow per share to us, to our account next year, again, on a consensus basis. Out 5 years is 15% accretive on cash flow per share. Not quite as significant, but that's because the growth already embedded in our existing portfolio really significantly kicks in over that 5-year horizon. So it's not nearly as accretive about 5 years, but still significantly accretive to us on all conceivable metrics across our various metrics.
And I'm sorry, how much did you pay for the asset?
$70 million in cash. And again, we bought it from BlackRock. Interestingly, BlackRock was the lead order in our equity financing. So they've cycled actually a significant portion of that $70 million in proceeds back into the company. One, because they believe in the asset. They've sold it to us to crystallize some value and start to diversify their holdings within the BlackRock Trust. But importantly, they believe in the growth that's already inherent in our existing portfolio of assets, and they wanted a portion of that upside by participating in the equity financing for the acquisition of that royalty.
And you mentioned that there was an equity deal in conjunction with acquiring this asset. How was that deal received?
Well, it was received very well, and it was priced very tightly to market, about a 5.8% discount, which is very, very, very low. We paid about a 4.5% commission on it. So all into our shareholders, about 10% discount, including the commission. It was 2 times oversubscribed. So initially it was sized for $70 million. We upsized it to 90, given the overwhelming demand, both on the institutional and retail side. And also the green shoe's been taken down. So the overall proceeds are $103.5 million. So well oversubscribed. And we've seen good price performance since we announced the deal because of the accretive nature of the acquisition. We had a very defined use of proceeds, but also because of the overwhelmingly large order book that we had.
It's a good way to end the year.
It is indeed, yeah.
So I'm very surprised too when you mentioned the asset came from BlackRock. I mean, of course, I know BlackRock's one of the world's largest asset managers, and I know them for equities and bonds and many other things, but I didn't realize they had royalties. Do they own many of them?
No, in fact, they don't. I mean, that's why it was an asset that was slated to be sold at some point. Our head of corporate development had a very strong relationship with BlackRock, knew that they had this asset, and eventually they would want to monetize it so they could cycle back into gold equities and other equities. I mean, they're portfolio managers at the end of the day, so really it's not their habit nor their core to their business strategy to own these types of assets, but it came into their portfolio as part of another transaction, and we were able to source it on a unilateral and exclusive basis, which has really been our secret sauce from day one. Every deal that we've executed has been done on a bilateral basis. And that's what's allowed us to get high rate of return opportunities like this. Competitive processes are very difficult to generate adequate rates of return to cover cost of capital. And I would say is from time to time we participate in those competitive processes, but we failed in every single one of them because there's always somebody with a lower cost of capital than us, and we really can't compete. We have to be leveraging the relationships that our board of management have to bring in these opportunities on an exclusive and one-on-one basis.
So, David, I want to move on and look at some of your flagship assets, and I want to start with Canadian Malartic. This is one of Canada's largest gold mines. I know there's always a battle going on for which one is the largest, but it's located in the province of Quebec. It's owned and operated by Agnico, and it's a large open pit, but they also have a massive underground expansion going on. Can you give us an update on that expansion?
Yeah, sir. It's well advanced. If you recall, it was a $1.6 billion commitment by Agnico Eagle to convert what has been an open pit mine for the last 15 years into an exclusively underground mine. In the course of doing that, they're actually descaling operations. They're going down to about a third of the production rate that they had historically because they're mining much higher grade material, bulk tonnage underground at just under 20,000 tons a day. But that means they're going to have a hungry mill. So they're going to look for other sources of ore, both along strike in terms of contiguous property positions that they own in the area, where we have royalty coverage as well. But as they go underground to set up for production, and they're putting that infrastructure in place, including a new shaft, which they've now committed to deepen and open up level development, that means they're going to get drill setups underground to start to drill the deposit for the first time from underground. That's when these deposits tend to balloon in size in the Abitibi district. There's a limit to what you can do from surface drilling, but once you get underground access, you tend to grow the deposit exponentially. That's certainly what happened at the flagship LaRonde mine that I was party to the construction of when I was the CFO at Agnico Eagle for 12 years back at the start of this century. And that's the hallmark of Agnico. Get access for production, get access for drilling, and then grow the deposit exponentially and look for opportunities to scale up production. And that's what we're going to see here. We're going to see a significant scaling of production as that underground infrastructure gets in place. We have a 3% net smelter return royalty on about half of the underground resource. So much more extensive coverage, on our royalty portfolio underground. And that means we're going to see quite a ramp up in our attributable ounces as they convert from an open pit to underground operation over the next couple of years.
The next asset I want to ask you about is IAMGOLD's Côté Gold Project, and this is located in the province of Ontario, and it's another huge mine, and it's been a huge win for IAMGOLD. Tell us about this asset and what it means to Gold Royalty.
Yeah, and you could have pointed out that it's, I think, number 2 gold mine in Canada right now in terms of production. And that's a recurring theme in our portfolio, in that we have royalties on 3 of the 5 biggest producing gold mines in North America, including, as you pointed out, Malartic, Côté, and we also have the underground extension of Gold Strike, which I'm sure you'll want to talk about a little later on. But Côté's ramped up quite smoothly in the last year, and it's already generated about a third of our investment on that royalty back in terms of cash flow in very short order, because they're mining extensively from the high-grade zone of the open pit, where we already have a 0.75% NSR. So they're focusing their production to a large degree from that high-grade portion of the open pit where we have royalty coverage. So that means we're getting a very quick payback on what was a relatively small investment for us very, very quickly. So that's going to be a meaningful contributor, and has been a meaningful contributor to our revenue this year. It's one of the reasons that we're free cash flow positive this year, is because of the ramp up of Côté, which has tipped us from investing in our business to actually generating and harvesting a return for the first time in our short history.
And you just mentioned Gold Strike and the underground operations there. Why don't we talk about that asset?
Well, Gold Strike is well known, I'm sure, among your subscribers, Jimmy, in terms of one of the most prolific mines in the world, one that built Franco-Nevada into the behemoth it is in the royalty space. And we actually have a royalty on the underground extension of Gold Strike, a deposit called Ren, which Barrick, from surface drilling, has delineated a 2 million ounce resource on. They're driving twin tunnels into the deposit. It's a $400 million investment in bringing that new deposit into production. It's initially a 2 million ounce deposit from surface drilling with 7 gram plus a ton material. So more than 7 times the grade they're mining from the open pit currently. So as you can imagine, Barrick is prioritizing that into their mine plan as quickly as possible to displace some of the lower grade mineralization. They're leveraging infrastructure that's already in place and has been in place for decades. So low capital intensity, quick lead time to production. Expected initially to produce 140,000 ounces of production from the underground starting in 2027, with a small amount of production being initiated next year in 26. But that's based on surface indicated resource of 2 million ounces. As they get underground for production, they're going to get underground drill setups. Recurring theme within our portfolio, access is really the only impediment to growing the mineral endowments underlying our royalties, and that's been the case with Ren. The estimates we've heard from Barrick is that deposit should be at least 5 million ounces in size once they get the access to drill it out, which means that ultimately they're going to have to rescale the production upwards from 140,000 ounces. And that means we're going to get a bigger royalty. Our royalty is a 1.5% NSR, so top line royalty, plus a 3.5% net profits interest royalty. So we get the benefit of both the top line and bottom line on this mine as they recover capital from the underground development they're putting in place currently.
And just because we're talking about Gold Strike, it has such a prolific history. This is, as you mentioned, a company maker for both Barrick and Franco-Nevada. Pierre Lassonde acquired this royalty for $2 million. It's produced over $1 billion in terms of cash flow. So it really speaks to the power of this model.
Yeah, no, it's fantastic. And that's why it's so important to have so many different pillars of growth. We did M&A when we had the currency to do so back in 21. When our currency just wasn't there for us and we couldn't do accretive deals. Then we started doing third-party royalty acquisitions. That's how we picked up Côté and the royalty on Capstone's Cozamin mine in Mexico, for example, or the copper stream on the Varus mine in Bosnia, the DPM now operates. And then we've done project financing as we did for Borborema back in 2023, and that entered production this year in Brazil, Aura Minerals cornerstone asset. And then we generate royalties organically, much as we've done in Nevada. Many of our royalties in Nevada were generated through our sweat equity, where we stake exploration claims around existing mines and deposits, as was the case with Red and Gold Strike. And then we farm the properties out to the operators and get royalties back in return, effectively for free. In fact, not for free. We get paid because quite often we get option payments on those properties. So we're getting paid to generate royalties for free for our shareholders. That means the rate of return possibilities are infinite as these projects eventually come into fruition and become productive mines.
So I want to move on and just touch on your balance sheet. You already mentioned the equity raise, and maybe you can just tell us again, you paid down or retired some converts, and you also increased your line of credit.
That's right. Well, we started the year with about $70 million of debt outstanding, and today we have zero. In fact, we have net cash position approaching about $20 million. And our available credit lines together with that means we have about $100 million of available liquidity and absolutely no debt on the balance sheet now. So we're in an excellent position to look at perpetuating our growth through new opportunities.
And David, at this time you don't pay a dividend, but is this something you might consider in 2026?
Well, we were just talking about that today. We're having a strategy session with our management team, anticipating getting our budgets done for 2026. And now that we're free cash flow positive, now that we're debt free, introducing a dividend or some form of return of capital to shareholders is definitely on the radar for us.
And David, I want to talk about your portfolio growth now and also cash flow growth, because given the strong gold price and also the strength of your portfolio, where can cash flow go by the end of the decade?
Well, just to give you in round numbers, we're hoping to exit the decade with about 30,000 gold equivalent ounces of production. Our cost structure is very static. Virtually, all of our royalties, our gold royalties, are pure royalties. They're not, very few net profit interest royalties or top line royalties. We have only one stream. It's a copper stream. So that means that we have no costs associated with any increases in the gold price because our G&A costs are fixed and actually have declined over the last several years as we've realized post-merger integration synergies from the companies we took over. So we brought our costs down, not up. And so that means every dollar of incremental revenue growth falls right to the bottom line. So if we're exiting a decade with circa 30,000 gold equivalent ounces attributable from our portfolio, and just for round number purposes, apply a $4,000 gold price to it, that's $120 million of revenue against $7 to $8 million of G&A costs. Put 25% taxes on that, give or take corporate taxes, you're still talking about well north of $75 million of free cash flow for annum after tax from this existing portfolio. And we don't have to put another dime in it because all of our royalties are completely bought and paid for. We have no capital calls, no installment payments. We get unmitigated leverage to increases in the gold price.
And having said all that, your market cap is currently around 800 million US. If you do attain that type of growth, where do you think the market cap could go by the end of the decade?
Well, if you apply a reasonable multiple to free cash flow, let's say 30 times, just to throw a number out there. And, this is a triple in terms of just simple arithmetic from where our share price currently is to where it could be with that kind of free cash flow and sustainable free cash flow profile from this existing portfolio of very long life mines. But again, foundational to the story is these long life deposits: Canadian Malartic, Côté, Ren, very long life. Varus, 18 years of reserve life, for example. Borborema, with this potential expansion and significant resource embedded in that, again, could be a 20-year reserve life ahead of it as well. So these are foundational assets that are going to be spitting out annuities for our shareholders for decades to come.
And David, I want to ask about valuation now. The last time you and I spoke, I think it was about a year ago, but your NAV, your stock was actually trading below NAV. Now you're trading at a premium to it. But of course, you want to move that premium closer to where the seniors trade, which is 2 times or greater. What will you and your team do in the coming year to improve that valuation gap?
Well, in coming tide has floated all the boats. We've seen not only our valuations start to go up a little bit, but some of our peers, many of whom have high quality portfolios as well. And this has been a subsector or a small section of the royalties and streaming sector that's really been largely ignored by generalist investors. And now we're starting to capture their attention because we have high quality assets in the best jurisdictions of the world with very, very significant growth. So I think growth is not the dirty word it was a year ago. But you're right, there's still quite a disparity between the multiples of the seniors and the ones that we're currently enjoying in the small cap universe. Typically the big cap guys are trading at 2.5 to 3 times price to net asset value, and we're still slightly above a third of that. So quite a disparity, quite a potential runway for a re-rate for these small cap players, in particular stories like ours that have high quality assets in good jurisdictions. And there's no reason we couldn't achieve that re-rate as we achieve critical mass. We're on the cusp on a fully diluted basis of going over $1 billion US market cap. We suddenly start to become very investable. And a universe that doesn't have a lot of mid-cap players, there's very few players in that $1 to $10 billion snack bracket that are what we call the Goldilocks zone, where you're big enough to be relevant for many institutions and liquid enough to own, but still small enough to grow. Because as great as those large cap companies are, Franco, Wheaton, and Royal, they're massive companies, great assets, great management and good cash flow, but they don't have the ability to grow off of the base they have. Franco, Nevada, and Wheaton, for example, are 100 times our size. And when we do a needle-moving transaction like Borborema, or for that matter, the most recent one, Pedro Branca, in that kind of $70 million snack bracket, Francos and Wheatons need to look at assets 100 times the size. There aren't $7 billion deals to be done in the royalty and streaming space. They just don't exist. So it's impossible for them to grow. And that's what we offer, is we offer trading liquidity. It takes us 60 to 70 days to turn our market cap. And we offer significant growth. So we offer the best of all worlds.
And because of this mismatch that we've seen between the NAV of the larger royalty companies versus the smaller ones, we've seen a lot of consolidation here in the last few years. Just recently, we saw Royal Gold come and acquire Sandstorm. Do you think this is a trend that's going to continue?
We do. And recently also in the small cap universe, we saw Elemental and EMX merge. And we think there's a value proposition in undertaking that consolidation. One is it creates critical mass quickly. And we've demonstrated through the multiple discussion we had a little earlier on, the size matters in terms of getting that premium multiple. And we're a cost of capital driven business. Royalty and streaming companies are banks. They're not mining companies. And what drives banks upwards is having a low cost of capital, which they can arb into high rate of return propositions. And so driving down our cost of capital is absolutely an economic imperative. But the other value proposition of putting these companies together is realizing G&A synergies, which can be significant. In the 3 companies we absorbed in 2021, we eliminated 100% of their G&A costs, because when you put royalty companies together, you roll a filing cabinet from one office into another. And that means you can realize full synergies. And that's a lot of value to capitalize. If you apply a reasonable multiple to that, that's, the $10 million of G&A synergies we realized, we captured $50 to $75 million of value instantly for our shareholders. And that's the value proposition, one of the value propositions of putting royalty companies together. And then we now have that added dimension of this crypto fund, Tether, coming into the space. And we're seeing the convergence of digital currency with gold suddenly. And so the traditional investors in digital currency are suddenly realizing that some of these digital currencies really actually need some backing. And gold is the best currency to back digital currency, because it's been recognized as a currency for 4 millennia and has physical properties. And people are looking for a tangible value to back these digital currencies, and gold offers that. So I'm not surprised to see this convergence, but we're seeing active investment in the small cap royalty universe from Tether. And I think, if anything, that'll incentivize and accelerate the consolidation that we think is inevitable among the smaller cap universe.
David, there are many royalty companies for investors to choose from. Why should an investor choose Gold Royalty over many of your competitors?
Yeah, look, I don't think it's an either or scenario. I think there are a few other companies that offer a quality proposition as well. And it's an unloved part of the sector, and we're all trading at multiples that are well below what the seniors are offering. But what we offer, our value proposition, one of the value propositions of putting royalty companies together, is realizing G&A synergies, which can be significant. The other value proposition of putting royalty companies together is realizing G&A synergies. And so the relative to some of our peers is very low political risk, with over 80% of our portfolio by value and number of royalties in Nevada, Quebec, and Ontario. Some of the most geologically prospective districts in the world with the lowest and political and regulatory risk. So I think that's a key differentiator as well. We have by far the best growth profile among the royalty universe, not just in terms of the smaller caps, but large cap as well. We offer 360% growth in gold equivalent ounces over the next 5 years. And that means exponential growth in free cash flow. We have a clean balance sheet, no debt on the balance sheet. That means no cost of carry on that growth. And all of our royalties are completely bought and paid for. That means that growth is very much in harvest phase. And all of that revenue growth falls right to the bottom line for our shareholders.
And David, as we wrap up, what can investors and viewers expect in terms of news flow from Gold Royalty in the first half of 2026?
Increasing earnings and cash flow over the course of 2026. With over $100 million of available credit lines and cash, we're in a great position to do accretive deals, much like we just did with Prater Branca, which is delivering significant growth in a net asset value per share, cash flow per share, earnings per share immediately for our shareholders. And we're very much focused on those cash flowing and near cash flowing royalties to complement the significant optionality that we've created for our shareholders through our generation program. We've generated all those early stage royalties for free for our shareholders. They offer the prospect of infinite rates of return as more and more of those early stage royalties hit over time, with more capital coming into the sector to complement what is already very significant embedded growth in free cash flow from the existing portfolio of producing and near producing assets.
Well, David, this has been a great overview and a great update. Thank you very much for spending time with us today.
Thanks, Jimmy.
Did you know that 80% of our viewers are not subscribers to our channel? So be sure to subscribe to our channel, Bloor Street Capital, and also hit that thumbs up button and leave a comment below. Thank you for your support. Sheldon, thank you very much for joining us today. For those who might not be familiar with Triple Flags, why don't you start by providing us with a brief overview of the company? How many assets are there? How many cash flowing assets are there? And how many gold equivalent ounces or GEOs?
Yeah, thanks, Jimmy. Real pleasure to be here with you today. We formed Triple Flag about 10 years ago, and we built the asset. We built the portfolio asset by asset, and we stand today with just under 240 assets. A little over 30 of those are cash flowing. In terms of relative size, we're the fourth largest streaming and royalty company in the world. We basically are following the same business model as Franco-Nevada and Wheaton Precious. And by that, we get streams and royalties on tier one mining assets that generate gold-linked and silver-linked returns for our shareholders for the long term.
And as you mentioned, you have 239 assets. I don't want to talk about all of them, but I want to focus on some of the larger ones which are going to be driving growth here in the coming years, and also those assets which have optionality. And I want to begin with your largest asset, and that's North Parkes. It represents 25% of your NAV. It's a copper gold asset in Australia. You have a stream on the gold and the silver, and the mine is owned by Evolution, and they've been very active in growing production and also the mine life. Why don't you take us through what Evolution has been doing?
Yeah, so Evolution has owned that property for just under 2 years now. Evolution's a tier one Australian-based operator. Their market cap is larger than 10 billion, so it's actually a really nice operator for that asset. And as far as assets go, it's actually an ideal cornerstone asset for a streaming royalty company. It's a copper asset. We get the gold and the silver. It's been in operation for over 30 years. There's decades of mine life ahead, and we're going to benefit from that. And what they're doing, I think, is really looking with fresh eyes at this property, and it's a massive property that our streaming entitlement covers, over 1,000 square kilometers. North Parkes as an operation actually is the largest landowner in the area, so they have a lot of the surface rights, which is really helpful for developing new ore bodies. The actual mining lease right now, like all the reserves and resource that they have, consists of just 26 square kilometers. So you look at the 1,000 square kilometers, also the 26, just see the potential there is enormous. What Evolution is doing is they're really putting money into exploration. They're looking at fresh eyes. A lot of the surface drilling there was actually quite shallow in the past. Originally, it was a gold mining zone. People went and found shallow gold deposits. And what they found is they exploited the copper, and they saw some copper outcroppings, copper ore outcroppings. those link up and they extend underground. So I think there's a lot of potential to go deeper and also to look at the potential for gold on surface that maybe wasn't interesting in prior gold environments, but now with $4,000 an ounce start to become more attractive.
And one of the great things about this mine, it's a copper mine, as you mentioned, but copper mines have significantly longer mine lives than a gold mine will. Some of them could be 50, 75, 100 years. You've already mentioned they've been in production for 30 years. What's the mine life on this now, and where do you see it going?
Yeah, so right now there's like 30 to 40 years of mine life there. But when you look at the resource entitlement, the resource there is over 500 million tons. And a really interesting feature of Northparkes from our perspective is the current milling rate is about 7.6 million tons per annum. So it's a very low depletion rate there of the known ore sources. I think there's great potential to expand the milling capacity, and Evolution has talked about this in their public comments that this is something that they're looking at. If they do expand the milling capacity, that of course would bring forward production. It would result in an increase in our entitlement. So that would be very, very attractive. And then on the back end, people at site there talk about this being a 100-year mine, and so like I think the potential to find more ore to backfill that acceleration is really strong. And as a streamer in royalty, you just benefit from that. So that's a real source of upside for Triple Flag. So I'm really interested to see what Evolution comes to the market with next year.
Sheldon, I want to ask you about another asset that's also based in Australia, and that is Beta Hunt, and it's owned by Westgold Resources. And there's been a large expansion also going on there. Can you just take us through that asset and give us an update on what's happening there?
Yeah, Beta Hunt's it's located in Western Australia. It's operated by Westgold. We got that asset as part of our acquisition of Maverix Metals, and we thought it was a good asset then. And since then, it's actually just shown itself to be even more than we thought it was. One thing is there's a zone called the Fletcher Zone, and that was an entirely new zone since we acquired our royalty on that property. They think that there might be an equivalent amount of mineralization there as the existing mine that we underwrote. And so that, of course, benefits us completely as they bring that forward. The other thing is Westgold is actually expanding the capacity of the Beta Hunt mine right now, and that's irregardless of the Fletcher Zone. So we're going to see an increase in capacity there, an increase in production. That's going to benefit Triple Flag. And then as they drill out and understand the Fletcher Zone better, that of course could lead to further capital deployed there, which as a royalty holder we will benefit from. And again, located in Western Australia, I think Australia is as good a mining jurisdiction there is in the world. It's exactly where you want to have your assets.
So let's bring it closer to home now. You and I are both in Toronto, and I want to ask you about Agnico's, or one of Agnico's assets, and that's Hope Bay. It's located in Canada's north. It's not in production right now, but Agnico's been doing a lot of work in terms of exploration and also optimizing a mine plan. Can you just take us through that, and what's the latest? What's happening at Hope Bay?
Yeah, it's a really good news story for Triple Flag and for Agnico, by the way, and it's a good news story for Canada as well. So we acquired this royalty as part of the Maverix portfolio as well. And when we acquired it, Agnico already owned the property. They were studying it, and we weren't sure if they would keep it in the portfolio or not. And they spent money drilling the property more and understanding what they had. What's really shown over the last year is Agnico's really gotten behind this project, and they've talked about this being 400,000 ounces of gold a year for decades to come. Agnico, I say, is the best operator for the Canadian far north. I mean, they have the history up there, they have the capability, and so seeing Agnico put their technical capability and their financial capability behind this asset, I think is wonderful. We have a 1% royalty on that, so we benefit from that as long as it goes. When you look at the entitlement we have, we always look to see what's our entitlement to the land package. It's a very large endowment. It's over 1,000 square kilometers there. It's district scale, and they are very, very excited that the potential that this mine represents. And so I would imagine that once they come to a decision to mine Hope Bay, it's very natural for these things to expand over time and also to extend their mine life as they open up new ore bodies.
And do we have a timeline on when Agnico will make that decision?
Yeah, they've told us that they should be announcing something on Hope Bay in I think it's H1 of 2026. So again, as a royalty holder, we don't have the direct drive there, but they've been quite public facing in that, and I'm really looking forward to see what they announce to the market.
Let's talk about one of your assets in the U.S. now. It's called the Arthur Gold Project. It was acquired with the acquisition of Origin. It's owned by AngloGold Ashanti, and it's located in the state of Nevada, also another great mining jurisdiction. Tell us about this asset and what it will mean to Triple Flag when it is up and running.
Yeah, thanks, Jimmy. Really excited about Arthur. We acquired this royalty in the middle of 2025, and as you said, it was part of the acquisition of the Origin company. We have a 1% royalty here, and AngloGold Ashanti is the operator. And this has been identified fairly recently, and the resource base has grown quite quickly. We have a number of members on our team who have a lot of experience at Barrick, including Goldstrike and Cortez, as those assets were developed previously. And we think there's a lot of analog between Arthur and those assets. So this could get very big. And that's exactly why we wanted to get on this royalty relatively early. We're really excited about the potential. When we bought the royalty, they had 16 million ounces of gold in the reserve. We thought there should be a lot more. There's a lot of public drilling data they put out. They put out some really good information, and we have teams of geologists and mining engineers. And we actually thought there was more gold there than the 16 million ounces. Subsequently, the company has said in public forums that they think that there's over 20 million already. So that actually validated our due diligence. So that's really nice. AngloGold Ashanti is going to come with additional studies and information to the market again in H1 of 26, and I'm quite eager to see what they report. On their last quarterly earnings release, they had some very nice diagrams which showed a good high grade core there that should form the basis of a nice starter operation, and I think the growth could be it could be immense, and so I'm quite eager to see what they report and also just how this develops over literally decades.
And Sheldon, this asset, it really speaks to the optionality, and this is one of the big benefits of royalties. And I can't help but notice there's a slide in your deck which shows Arthur Gold Project, and you compare it to Goldstrike. Maybe you can just speak to that, and why do you think it can become so large?
Yeah, a really nice feature of the royalty business is your first check is your last check. And so when you think we put our money into acquiring this royalty. Now, as AngloGold Ashanti develops this project, they're going to pay for drilling, they're going to pay for development, permitting, studies, the capital requirements to build the mine. And that actually can go on for decades because sustaining capital is quite large. And as a royalty holder, you get a free carry on all that capital. You get a free carry on the capital that's already been expended on a property and the future capital that gets expended on the property. And that's really powerful. And so one of the things you think about is what sort of properties attract capital to get exploited and get developed and start to produce cash flow. And features like being in Nevada really aid that. The barrier to deploy capital in Nevada is much lower than in some of the harder jurisdictions of the world. You also just look at the topography in Nevada. So I was talking about political risk there, the legal regulatory regime. The topography is very good. It's easy. There's a lot of experienced miners, and the ecosystem for mining is strong there. The communities support mining, and then the grades we're seeing here are quite robust. So you already have enough there to have a very profitable mine, and then that attracts more drilling and the desire to expand. So when we look at a property like this, we're comfortable that we're going to have a very nice, attractive mine that will make a really good return for Triple Flag shareholders. But the upside will be revealed literally over decades. I think we could be talking in 15 years, and we'll be talking about things that we can't contemplate right now, but that property will be attracting the capital to develop and expand.
I want to move on now and talk about your balance sheet and also capital allocation. And you and your team have been very busy this year. As you mentioned earlier, you acquired Origin Royalties earlier in the year. You're paying a dividend. You're buying back stock. How does the balance sheet look right now, and how will you allocate capital in the coming year?
Yeah, so right now we're debt free. We have a little bit of cash on the balance sheet. We're quite pleased to be here. And really what our business model is we have this robust portfolio that generates really robust cash flows. And we take those cash flows and we do a couple things with them. One is we pay a dividend and we increase our dividend every year. So every year since we IPO'd in 2021, we have increased our dividend, and we're going to continue doing that in the future. The biggest driver of shareholder value is we take those excess cash flows and we redeploy them into further investments. So this year we did the Arthur project, we did the Sierra Sun acquisition, we did the Monera, Florida acquisition, and that just generates compounding growth over time that doesn't dilute shareholders because we're compounding our growth through existing cash flows. We're not tapping the equity markets. We don't like issuing shares. And then the third thing is from time to time, we'll use the NCIB and we will buy back shares because that's a fantastic way to shrink the denominator, shrink the number of shares outstanding. What I always care about are we growing the asset value per share and are we growing the cash flow per share? And that is the real measure over time about whether we're generating wealth for our shareholders or not.
And earlier this year, you also increased your credit facility to $1 billion. What was the reasoning behind that?
Yeah, so again, the capacity of Triple Flag has grown larger as our cash flows have expanded. If you look at our history from when we IPO to now, we've grown our cash flows very, very significantly. That's a two-barrel impact. One is we've increased the production, and second, the gold price has flown through, and we've benefited from that. We have more debt capacity. I don't like equity dilution. I don't like more value has been destroyed by equity dilution in the mining sector than probably any other single factor. And so we guard our equity very, very jealously. If I had a $500 million investment to make, I'd much rather draw down the debt, not dilute my shareholders, and then pay down that debt using the cash flows on the portfolio. And our run rate right now on cash flows is over $300 million a year per annum, and that's at current prices and current production levels. So that's quite robust. So if we borrow $600 million, that's a very reasonable burden for Triple Flag. And I'd much rather borrow the money than issue equity and dilute.
And Sheldon, in addition to acquiring Origin, you also acquired Mavericks in 2023. And if you could find another deal that was accretive both on a NAV basis and also cash flow basis, would you do that?
Yeah, you hit the nail on the head there, Jimmy. Absolutely. I think the key is we like to stay focused on gold and silver. But if it's gold and silver in a good portfolio and we do the diligence, we are open to deploying capital in that way. I actually don't see buying a company like Mavericks as any different than buying a portfolio of streams and royalties. And you just look at value, and it's really diligence. So you got to go through the list and make sure that you have good value beside each asset that you're acquiring. What I'm really pleased with is we did the Mavericks acquisition in 2023. Looking back now, that was an absolute home run for Triple Flag, which tells me that our diligence was done right, and we weren't over optimistic, and we had allowed for margin for error. But when I look at the Hope Bay royalty, we acquired that through there. Beta Hunt, we acquired the Kensington royalty, Kone royalty. Like the list just goes on of really good things that. Some of them we thought were good assets, but they turned out to be much, much better, even irrespective of the gold price, than what we thought at the time.
And given the move that we've seen in gold and silver in the last couple of years, is it harder to find deals that are accretive on an NAV and cash flow basis?
I wouldn't say that. Yeah, I wouldn't say that at all. It's not harder. It's probably about the same. There's really 5 competitors for assets, and we're one of those 5, and so we're always looking. We have geologists, mining engineers. We have networks within the mining industry. We look at a lot of things. For every deal that we announce to the market, there's probably 100 things that we've looked at in some way, shape, or form. And so you're really seeing the end result of a lot of looking. And some of the assets that we look at, our competitors get. But we're quite happy as long as we're able to find good assets on good terms to deploy into. That works really well and will drive that compounding growth. In 2025, to date, we've done $350 million worth of transactions. That's actually a really good number for a company of Triple Flag size, and that's in that higher metals price environment. So I'm actually quite confident on our ability to find good investments for Triple Flag shareholders going forward.
And can you just speak to the current pipeline? What are you seeing out there right now in terms of deals? How many are there and what kind of size?
Yeah, what's nice is the pipeline has it's not all the same, right? And there's a lot of different features. There's some that are quite large. It's like the over 500 million. There's some that are more mid-size. I'd call that like 250 to 500 million. And there's a number of smaller ones. And I have no problem at all doing a really good $50 million deal. I'd rather do a good $50 million deal than a big, not so good deal. And that should be self-evident, but I think at our size, it allows us to deploy that way. There's things like M&A financing, project financing is always there. You also look at jurisdictions like, where's the mix coming from? I think it spreads across the good jurisdictions like Australia, Canada, the United States. There's also very good mining jurisdictions throughout Latin America. And I think we can find ways to deploy in jurisdictions that our shareholders really like, on terms we like, with good operators. But really, it's a deep pipeline, and it's very varied. And a lot of our job is to look through that and find the best opportunities for our shareholders and decide where we want to put our dollars.
And as we already discussed, M&A has been a big theme here in the last few years. In addition to you being very active, Royal Gold just acquired Sandstorm. Do you think this is going to be an ongoing theme within the sector?
I think it is going to be. I mean, at some level, these are easy companies to put together in that they're small management teams, they're portfolios of assets. And we really saw with Mavericks that we were able to generate good value. And we issued shares on the Mavericks deal. It was a good deal for Triple Flag shareholders, but it was also a good deal for Mavericks shareholders. So I think these are sort of things that actually can generate value on both sides. It takes two parties to come to agreement on value. And if you're using stock to pay for the deal, you have to come to agreement on relative value. And I think that's really part of the driver as to like whether you find a transaction or not. And it's not an either or proposition. Like, we're talking to operators all the time. We're talking to people that hold third party royalties all the time. And then we can look at the other opportunities as well.
Sheldon, as we wrap up, you've already discussed a lot of the details on what's happening with some of your larger assets, but maybe you can just provide a summary for viewers and investors on what they can expect from Triple Flag in 2026.
Yeah, we're doing really well right now, and I'm quite pleased with how the portfolio is going and what our prospects are going forward. So, as I wrap up 2025, we're coming in at the top end of our guidance range, which is very exciting, and you should do that. But it's always nice to actually deliver that for shareholders. And then as we go into 2026, there's a few key catalysts that I'm really looking at, and you touched on some of them. And one of those is Northparkes has developed the E48 sublevel cave throughout 2025, and that's going to be going into production. As 2026 evolves, and we're going to benefit from that. I'm also looking forward to Northparkes potentially making an announcement on their E22 block cave. That's a high gold grade zone, very accretive for the Triple Flag stream there, and they've said that they're going to come forward with some kind of decision there going forward, which would be fantastic. The other thing is the Hope Bay, which we touched on, and the Arthur royalty, which is good. Montage Gold is developing the Koné project in Côte d'Ivoire. They've been doing really, really well. They've targeted first production in 2027. So far, they've been actually ahead of their milestones. So, I'd like to see good development project progress there as well, and continued progress towards that 2027 start date. So there's a lot of catalysts and developments in our portfolio, which are going to be driving value as we go into 2026.
Well, Sheldon, that was a great overview and a great update, and I want to thank you very much for spending time with us today.
Thanks so much, Jimmy. A real pleasure.
Hi, it's Jimmy, and I hope all is well during these crazy times. Well, we have over 50,000 subscribers on YouTube, and I want to thank you for your support. But now I need your help on Spotify and Apple Podcasts. So please follow us on Spotify and Apple, leave a rating, and leave a comment. And if you have any suggestions on guests who you would like to see interviewed, let us know in the comments section. Thank you for your support. Dan, thank you very much for joining us today. Many investors might remember you from Mavericks Metals, which was acquired by Triple Flag in early 2023. But for those who aren't, can you just touch on Mavericks and when did you get involved in your current company, Versamet?
Well, thank you for the introduction, and I appreciate the opportunity to talk about Versamet, my prior experience at Mavericks, which I co-founded in 2016 as a startup precious metals royalty company. Built a high-quality portfolio of royalties and streams, and ultimately sold to Triple Flag for approximately US $750 million. There are many parallels with Versamet to Mavericks, including building that strong, diversified, cash-flowing portfolio and taking advantage of an opportunity to fill in the gap between the larger intermediate royalty companies and the very small caps, where there's a tremendous opportunity to build that attractive portfolio of precious metals, royalties, and streams.
And Dan, I have to ask you about your shareholder base. It really stands out. Some of the more notable names include B2 Gold, Equinox Gold, the Lundin family, but also Tether. And Tether is a large buyer of physical gold or a large holder of physical gold. And they've also been acquiring positions in various royalty companies. When did Tether get involved in Versamet?
This is a very topical conversation for the company, as it has been very recent that Tether and the Lundin family came on as 12.7% shareholders each independently. They acquired that position from Royal Gold, who inherited a 25% shareholding in the company through Sandstorm. So if we go back to the history of the company, it was originally spun out of Sandstorm and Equinox. Equinox remains on our registry at 12%. Notably, we've added B2 as our largest shareholder at 33% through the acquisition of an all-share transaction that brought in a portfolio of gold royalties that are going to be contributing to Versamet going forward. So we've got B2 at 33%, Tether and Lundin family at 12.7%, Equinox around 12%. And I should note that insiders as well are north of 10% and very much aligned with our shareholders.
I want to move on now and discuss Versamet in more detail. You have 28 royalties, and in 2025, the gold equivalent ounces, or GEOs, were 10,000. They're expected to ramp to 20,000 in 2026, so that's significant growth. Why don't you just take us through those assets which will contribute to this growth? And I want to start with Greenstone, which is located in Northern Ontario. It's owned by Equinox Gold. They declared commercial production, but they are ramping. And take us through this asset.
Certainly, Greenstone is one of many assets that we have in the portfolio that are producing, but not yet ramped up to full nameplate capacity. And Greenstone continues to ramp up, as does the royalty that we have on Blackwater, also in Canada. We also have growth coming from the Kiaka mine, which just came on stream in June. We also have expansions at Rosh Hashanah, which was recently added to the portfolio. So the growth in our portfolio is already producing assets that are either going through expansions or currently ramping up production, or are simply new to the portfolio, having just been acquired by the company. But we look at the track record. In 2004, we had 5,000 gold equivalent ounces. In 2025, we'll have 10,000 gold equivalent ounces. In 2026, that ramps up to 20,000 GEOs. So a very strong track record of ramping up quarter over quarter, year over year at gold equivalent ounce attributed production to Versamet.
And has Equinox Gold stated when they're going to be at full capacity at Greenstone?
First of all, I think they're doing a great job ramping that up. It's been a little bit slower, but it'll continue into 2026, and we expect it to hit that in 2026.
So you did touch on this, but you also acquired two assets from Appian, both of which are cash flowing. Take us through that deal and what do these two assets mean to Versamet?
We're tremendously excited about this transaction. It was $125 million in upfront cash consideration, plus $45 million in contingent consideration on certain throughput milestones for the underground expansion at Santa Rita. The highlight and the summary is that these are two operating mines that are already cash flowing, but they also have growth catalysts ahead of it, coupled with long mine lives. Looking at Rosh Hashanah specifically, this is a producing zinc mine in Namibia that's currently undergoing the RP 2.0 expansion, which will essentially double throughput by 2027. We acquired the silver production, so we have a very significant silver stream on this asset. It's a very operating mine life. It's had over its 55-year operating history. Its mine life has been measured not in years, but in decades. Incredible exposure for Versamet here with the silver stream. On Santa Rita, this is also a cash flowing mine. It is an operating open pit nickel mine, currently producing, but Appian is evaluating a long mine life underground potential, which is what our contingent payments that I previously mentioned are linked to. But when this moves forward, it becomes well north of a $10 million per year royalty, well into the 2040s and 2050s. So in summary, two operating mines, both with growth catalysts, both with long mine lives, and under the great stewardship of Appian.
Dan, I wanted to get your views on optionality now, and this is one of the features that make royalties and streams so attractive. Is there one or two assets that you would highlight which could be a huge winner at some point in the future?
I think this is one of the attractive strengths of Versamet is that we have optionality throughout our portfolio. On the front end of our portfolio, that has optionality through existing production being expanded. That's going on at Roche-Penau, as I mentioned. There's the underground at Santa Rita. Kolpa, which Endeavour acquired from a private company earlier this year, is going to see some expansion and exploration work. So at the front end, we have optionality, but also on the back end as well, where we have royalties on significant mineral inventory assets that have defined resources but aren't necessarily on the fast track to production right now. I'm referring to assets such as Hackett River, Prairie Creek, Mason, Converse, all of which where Versamet has a royalty interest. So we see these as call options on gold, on silver, on copper, on zinc, and call options that have no expiration or holding costs. Particularly, I see upside in Hackett River as the infrastructure in the north ultimately gets unlocked. But I think that's one of the benefits of portfolio theory, where we've got optionality throughout the entire portfolio itself.
Dan, I want to move on now and discuss your balance sheet. What is your liquidity and how will you fund acquisitions going forward?
Another one of Versamet's strengths is our access to capital. With our very positive and strong cash flow profile, we have significant access to credit. Specifically, we have 180 million of credit facilities, which are predominantly drawn right now to affect the Appian transaction. We have, with that strong revenue and cash flow profile, the ability to pay that back quickly. That's less than a 3-year payback at current cash flow. So we can continue to draw on credit facilities. We also have 2 new shareholders that have seen a propensity to invest in the mining sector and the royalty and streaming sector. So we're very comfortable and confident with our access to capital going forward to continue to grow the portfolio.
And in terms of deal size, what would you say Versamet's sweet spot is?
I would say that the typical transaction range that we're evaluating is in the $50 to $100 million range. If you look at the transactions that we completed in 2025, there was a $35 million stream on Kolpa that we acquired from Endeavour, and then the $125 million acquisition from Appian, although that acquisition included 2 assets, both the Roche-Penau silver stream and the Santa Rita royalty. But I would say typically 50 to 100 million, some smaller and some larger than that.
And you touched on this earlier, but there are a lot of other royalty companies out there, and we've seen a massive move in the price of both gold and silver here in the past 2 years. Have these 2 elements made it more difficult to acquire royalties and streams?
Well, it's always a competitive landscape in the royalty and streaming sector, but I think one thing that's very important to note is the size range that you're competing in. And as I mentioned before, the $50 to $100 million, these are royalties and streams that will certainly move the needle for Versamet, but might necessarily not get the larger companies all that excited, as it doesn't particularly move the needle for the larger royalty and streaming companies. So we're seeing a tremendous amount of opportunities in a size range that we're looking at that will allow us to continue to grow accretively and responsibly.
And what would you say separates or differentiates Versamet from your competitors?
That's a great question. I think there are a couple aspects that I can touch on. The first is track record. Certainly a very strong demonstrated ability to grow the asset portfolio, not just at Versamet, but having the team done it before at Maverix as well. And right now we're in the Goldilocks zone size range in the precious metal royalty and streaming landscape, where we are large enough to have strong positive free cash flow and diversification for shareholders, but also the ability to meaningfully grow percentage-wise. Specifically, I'll note the Appian transaction, which took our 2022 forecast gold equivalent ounces up from 15,000 GEOs to 20,000 GEOs post-transaction. So that transaction alone added 33% to our gold equivalent ounces and cost less than 20% of our enterprise value. So being able to provide diversification, cash flow, but also the ability to grow is a very attractive setup for our shareholders. And looking at where valuation multiples are in the sector, price to net asset value or price to cash flow, from where we are today, there's significant upside in Versamet as we unlock a number of capital markets milestones, including a US listing, more research coverage, increased liquidity, index inclusion. That's a very big one. And all these catalysts are in our future. So we're looking forward to unlocking each one of these milestones, as each individual step forward will lead to and should lead to higher valuation multiples for the company.
And Dan, I'm curious about the time that you spent at Maverick Metals because of the success that you and your team had there. What were the main takeaways? What were the main lessons that you learned there? And is there anything that you learned there that you're going to do differently at Versamet?
Actually, I'll stick with the ones that will do the same, which is focus on asset quality. I think that was absolutely the biggest factor in the success of Mavericks was continuing to focus on asset quality and building a high quality portfolio. Mavericks in its early days was very challenged on liquidity, as is Versamet as a new company. But once you build an incredibly attractive vehicle, the investors will come, M&A suitors will come. So our focus is continuing to focus on asset quality and build the portfolio in the correct manner. And when I say asset quality, it's the underlying asset itself, but also we want to stay focused on precious metals, diversified geographically, cash flow with upside. And I think that's shown through in the transactions we've done to date.
Dan, as we wrap up, you and your team have been very busy in 2025 and taking Versamet public and also closing on 2 large deals. But what will be your focus in 2026 and what can shareholders expect in terms of news flow in the first half of the year?
I think there's 3 avenues of very positive news flow. The first is on the asset side. We're in ramp up mode or expansion mode. So a very healthy quarter after quarter, year after year increase in our gold equivalent ounces. And that's just organically. We'll also continue to add to the portfolio through new responsible and accretive acquisitions. There's a full pipeline right now. We've got a track record of growth, and I think we'll continue to add new precious metals, royalties, and streams into the portfolio. The third avenue is on the capital market side. Having built this initial portfolio, delivering cash flow, returns, and ability to fund future growth, we now can ramp up the focus on the capital markets profile, including the U.S. listing, which will hopefully drive liquidity, bring new shareholders and new analyst coverage, and a higher profile, which should all lead to higher valuation multiples for the company and its shareholders.
Well, it's all about getting out there and telling the story, and that's why we're doing this interview. And I want to thank you very much for spending time with us today and sharing the Versamet story. Congratulations.
Thank you for having me on. I appreciate that.
Hi, I hope you're enjoying the conference. Did you know that 80% of our viewers are not subscribers to our channel, Bloor Street Capital? So please hit the subscribe button and also hit that thumbs up button. Thank you for your support. Randy, thank you very much for joining us today. How are things in Vancouver?
Fantastic, Jimmy. Fantastic. Really happy to be back on the show.
And it really helps to see gold trading at all-time highs and silver also at all-time highs.
Yeah, it's something that we've been it's been a strong uptrend in precious metals for quite a while now, and now we're really starting to see a new setting, a new level. But I don't think we're anywhere near finished.
That's good to hear. So let's get into it, and I want to start with the very basics. Wheaton Precious Metals is a financing company that provides financial solutions to mining companies, and it does this with streaming agreements. And I want to start right here with the basics. What is a streaming agreement, and how is it compared to a royalty agreement?
So a streaming agreement is a contractual partnership between an operating company and the streaming company. And that agreement focuses on typically non-core byproduct precious metals production. Most of our production comes from copper mines, and so just about every copper mine in the world produces a little bit of gold, a little bit of silver. And so we focus on that gold and silver as a non-core byproduct. And we set up a contractual agreement with the operator where for a lump sum upfront capital payment, a big upfront payment, we will get the rights to a percentage of that precious metals production. And when that precious metals production is ultimately delivered to us, we also make a production payment that is typically about 20% of the spot price in the of the metal itself at the time that the metal is delivered. And so, it's a relatively simple. I mean, as we say, the simplicity of a streaming agreement is sometimes confusing. Everyone thinks it's, but really what we're doing is purchasing the right to a portion of the metal production in the future. And for that, we get a fixed price. And what that does for our shareholders is dramatically reduces, if not totally gets rid of, cost risk, which is always one of the biggest challenges in any resource investment. The second part of the question, how does it compare to royalties? Well, it's a lot better than royalties, and I would say that that's further reinforced by the fact that the traditional royalty companies are now, most of the revenue now does come from streaming agreements. I'll tell you why it's better. There's several different factors. First off, one of the big advantages is that upfront capital, when we're buying a stream, that upfront capital that you pay is only purchasing about 80% of that value, because, as I said, there is a downstream production payment of 20% of the spot price. And so when we're calculating the value of that upfront payment, it's only about 80% of the value of the metal that you're acquiring. When you buy a royalty, you're actually paying for 100% of that metal, because there is no downstream production payment when a royalty operates. And what that means is that we're much more effective with our capital. We get over 20% more exposure on a per dollar basis with our invested dollar into a streaming agreement than what a royalty company would get buying into a royalty. And so having 20% more ounces on a per dollar basis makes streaming that much more attractive for the streaming company. Secondly, most of our agreements are funding growth, and when they fund growth and construction, we drip feed the payments over that construction period. And what that does, just by logic, is it reduces the permitting risk, because construction doesn't happen until permits are issued. And so whereas a royalty you have to pay for entirely upfront and then patiently wait on a development project until permits are in place and then construction commences, a stream typically drip feeds the capital over a construction period, which means much less permitting risk than what you'd have in a traditional royalty in a development scene. And then thirdly, and also important is that we have a production payment at the end. So while the mine is up and operating, we are paying 20% of the spot price typically. What that does is gives our shareholders leverage. We actually outperform. We dramatically we get much more cash flow and leverage as commodity prices climb relative to either bullion or a royalty, where there is no production payment and you're just getting full exposure to the actual commodity price itself. This is again another advantage of streaming, and so all of that adds up to streaming being the new way to finance metals in the industry, and typically focused on precious metals. It also, one of the advantages for a stream is that it focuses on a specific metal, a specific commodity, which allows us to be essentially pure precious metals, versus a traditional royalty will typically take a slice of all the metal that's being produced at a mine, including the copper, the lead, the zinc, etc. So a lot of advantages over the streaming model, and we are 100% streaming, and 100% of our revenue. We do own a couple of royalties, but they're nowhere near cash flowing, and so our focus is on continuing to grow the streaming database.
Great overview, and thank you for sharing that. Now let's move on and discuss some of your more recent transactions. And the first one was the Hemlo Gold Mine. This is in the province of Ontario. Hemlo Mining is the owner. Tell us about this deal and how will it benefit Wheaton in the future?
Well, Hemlo is a long-standing history. Back when I first started in this industry, close to 40 years ago, Hemlo was a market darling. It was a new discovery right beside the Trans-Canada Highway in northwestern Ontario. A lot of people didn't believe that you could find such a great gold mine right beside a national highway, the national highway that crosses through, the only national highway that crosses through that part of Ontario. But it has proven to be a long time, very successful producer, owned by Barrick originally. And Bob Quartermainer approached us probably about maybe 3 months ago and said, let's work together to try and move this project forward. Now, Bob, of course, has a long history of success in the industry, numerous successful ventures in the space, a good old school geologist who actually spent the early part of his career working at Hemlo, and has a lot of history at the site itself. In fact, during the due diligence, he brought some of his old notebooks from 25, 30 years ago when he first started working at the mine, and was comparing notes to how the place has progressed. So he knows the asset well. It was a strong due diligence trip. Owned by Barrick, and I would say largely forgotten about by Barrick. It was a small producer in Barrick's empire. It was the last Canadian asset in Barrick, last Canadian producing asset within Barrick. And its production levels, it has definitely seen its peak in terms of production. Although I do think that there's a good opportunity for a rebirth. And so Barrick ran that operation at about, in fact, when we first started looking at it, their reserve base was estimated at $1,400 gold, not the $4,200 gold that we see now, but 1,400, less than a third of what the spot price is. And so we see a great opportunity there in terms of actually just refreshing the resource base. And in fact, our own studies had substantive growth just by pushing the price of gold up to 2,100, 2,400. We saw the potential for a mine life well in excess of 20 years. And not only that, a potential to ramp up production. There is mill capacity at the site. And so anyways, our stream was $300 million. And for that, we'll get about close to 15,000 ounces a year. I actually think there's a good potential to see more than that over the next while as they start focusing on optimization. I think an asset like this, well, in fact, history has shown that an asset like this put into a small company coming out of a major, big diversified operator into a small focused company, always has unlocks some value in terms of efficiencies and optimization, truly. And we've got a workforce there that's really excited to take ownership of their asset again and continue to push this forward. So really excited about what this asset's going to deliver.
So another deal I want to ask about is the Spring Valley project. This is a development project located in the state of Nevada. Waterton Gold is the owner. What were the details of this stream?
Yeah, it's again another really exciting opportunity for us. It's our first major investment into the state of Nevada, and I think I like to say we made this acquisition without having to pay a Nevada premium that we've seen so many of our peers pay, which I've never been able to figure out how to calculate what that Nevada premium is actually calculated. We got a really good deal here. The Waterton Group has owned this asset for quite a while and decided to move it forward. The address is a great address. It's immediately north of Coeur's Rochester mine and south of the Florida Canyon mine. And so definitely a mineralized trend that passes right through this property. It's a large property that has been seen minimal work on it. It's got a reasonable resource in the Spring Valley deposit right now. It's a simple Nevada heap leach. Pick it up, blast it, pick it up, haul it over. Depending on the price of gold at the time, you can decide to whether put it onto the run-of-mine heap leach pile or put it into the waste dump. And my belief is that we're going to see a lot more material. Most of the resource was done at 2,000. I think it was $1,800 or $1,900 gold for reserves, and just a little bit over 2,000 for resources. When we push the price up closer to reality, to what the spot price is today, the entire drill hole database disappears into an open pit, which means it's dramatically under drilled. It has incredible potential. We've looked at Rochester to the south, which is continuing, just phased into another expansion. That mine has been operating for well over 50 years. Same with Florida Canyon to the north, and I just think this is an address that with continued reinvestment will be a long-term producer for us. Nice, simple Nevada heap leach. And again, we're expecting at least 25,000 ounces a year from this. To be honest, given the fact that it's not production limited, a run-of-mine heap leach is really just about being able to put the material onto the leach pad itself. The only limitation is how fast can you build new heap leach pad, which isn't really a limitation. Given that, it wouldn't surprise me to see this asset delivering well over 30,000 ounces of gold a year to our credit. And so, again, really excited about the partnership. This is the second transaction we did with the Waterton Group. Mineral Park, of course, just started up earlier this year. And again, one of the focuses and one of the differentiating factors that I think we have at Wheaton is that being a partner of preference. Waterton called us up. It wasn't even a competitive process. We just ran through the Spring Valley process without having to go through an auction because they had faith in us being a fair and equal partner in terms of trying to unlock value for all parties. And so it's a good example of why Wheaton works.
And Randy, the project is fully financed with $1.3 billion in committed capital. When will construction start?
Construction's starting shortly. We expect to have production coming up by the end of 2027, probably or early 2028. I would say by the end of 27 is possible because there's not as much there. One of the reasons they wanted to accelerate was they've already got a bunch of the equipment purchase contracts in place, and so a lot of the mobile equipment is starting to get put together and delivered to site, and so we're expecting construction shortly. They've got to work their way through a couple of last little local permits. Again, our money is drip fed over the construction period, so we don't have to pay until the construction starts. But we expect it to start imminently.
So I want to get an update on one of your cornerstone or flagship assets, and that's Salobo. And this is the largest copper deposit in Brazil. Vale is the owner-operator. There's been a major expansion going on there, so maybe you can give us an update on how things are progressing.
Yeah, it's the gift that keeps on giving. Salobo, of course, has I think returned to its glory. We signed the original Salobo contract back in 2013, and really from 2013 to 2020, that asset outperformed even our expectations. So rare in this industry. Had a few challenges through COVID, a couple of years where it missed guidance, and we all suffered as part of that. And it was a combination of just a breakdown in the preventative maintenance program that kept the mine running. It so, but Sean Usmar is the new CEO of Vale Base Metals. He's capitalized on some previous efforts and has done a great job in terms of pushing this asset back up to being the outperformer that it has a long history of being. And so to have a stream, we get 75% of the gold from this mine. And to have a stream on this asset as a flagship is great. It's Vale, which is a fantastic partner to have. It's Brazil, a great country to invest into from a resource perspective, and then of course the Salobo mine. Perhaps most exciting is that during the recent Vale Day Investor Day, they committed to a coarse particle flotation process that should increase throughput capacity over the next 4 years by about 15%. Now it's going to mean some lower grade material going through, but it does mean ultimately, I would say about 10% more gold production than what we were forecasting. And for an asset like that means an additional 25,000 ounces a year to our credit. The nice thing about the Salobo contract is that the price is fixed. It's not a 20% of spot price. It is down in that I think it's $430 or $450 an ounce range. And so very, very high margin ounces. And again, it's as a flagship asset, it just keeps getting better. We keep on trying to grow the company around it, but Salobo grows as fast as we can add new assets to the portfolio. And it's a great problem to have.
So we talked about a number of your assets, and why don't we talk about your growth profile now? Production is expected to grow 40% by 2029, and this will take your gold equivalent ounces to 870,000 versus the range right now of 600 to 670,000. But what assets will be driving this growth over the next few years?
Well, in fact, Jimmy, it's even better than that. That was the guidance that we came out back in February with. But what we have seen is with these record high gold and silver prices, dramatic acceleration of expansion plans from just about all of our partners. And so we're seeing just incredible drive for growth over the entire portfolio. And so I'm pleased to share with you that it looks to me like we will actually break through 1 million gold equivalent ounces by 2029, which is probably 60% growth instead of the 40% growth that we promised back in February. And really some of that comes from, as we already talked about, Salobo. By 2029, we'll have another 15% of throughput capacity. Artemis Blackwater, that project has just gone on to a continuous expansion plan. The original process, there was 3 phases to that, and it was going to be phase 1, run it for a while, phase 2, run it for a while, phase 3. We weren't expecting phase 3 till 2032, 2033. It now looks like they'll be finished phase 3 expansion by 2028. And so we're going to see a dramatic uptick in production from Artemis at Blackwater. The Platte Reef project, Robert Friedland, it's finally started production, as to quote Robert, the baby mine, which is only 1 million tons per annum, coming up the shaft, has just started. But their expectations is to have that up to 10.7 million tons per annum by 2029. That's significantly faster. We had that again scheduled for 2033, 2034, but Robert, I think, has realized that there's an excellent opportunity with platinum and palladium prices right now to get Platreef up and going at max capacity, and so they are pushing hard to get to that production level by 2029. A bunch of lesser expansions, but definitely still contributing to it. Aris Mining. The Marmato Deep Zone, shortly after we announced our guidance earlier this year, they came out and updated their throughput capacity for the new mill they're building by increasing throughput capacity by 25%. So we'll probably see 20 to 25% more gold production from Marmato than what we were expected. Montage at the Koné project, first off, ahead of schedule. Looks like they'll actually be producing gold by the end of 2026. Which is 3 to 6 months earlier than what we were forecasting, or at least 3 months earlier than what we were forecasting. But not only that, they've actually found some much higher grade material on an ongoing exploration program, where it looks like the grades may be as much as twice as high as what was originally forecast. And so if they can phase that in the early years and bring that into the production profile, instead of the 60,000 ounces a year that we get 20% of whatever gold is produced at that. It looks like that mine will now be producing well over 300,000 ounces, probably closer to 400,000 ounces a year. There's still a lot of work to do in that drilling, but as that gets phased in early, it's within kilometers of the existing mill. Bringing that higher grade material in could dramatically bump up our production level from 30 to maybe even as high as 45,000 ounces a year from that asset. And so, 60 to 70 to 80,000 ounces a year, because we do get 20% of whatever the production is at that site. And so, everywhere we look, a bunch of other smaller things. Rio 2 is doing really well at the Phoenix project. Cangrejos taken over by CMOC, bought from Lumina. And CMOC has been in our office here just recently telling us how they expect to have that mine up and running by 2028. We didn't have that scheduled until 2032, 2033. That's going to add another 15 to 20,000 ounces of production. El Domo, Silvercorp, again, advancing forward, and looks like it's going to be pushing forward. Santo Domingo with Capstone. They've formed a partnership with Orion. Looks like they're going to be moving that project forward. And again, that was one we didn't have scheduled until the 2030s. And so all the way across the board, we just see dramatic improvement in pushing forward production. Combine that with acquiring Spring Valley and Hemlo. And all of that adds up to over 1 million gold equivalent ounces a year by 2029, a 60% growth profile, by far the strongest growth profile. And the bulk of that is in construction already. It's already being done. There's a couple of projects that are just waiting for that commitment. We've got Copper World just waiting for that commitment, finishing off the feasibility. Will be in construction by the end of this year. I would imagine Santo Domingo will be like that. Cangrejos is probably starting construction next year. All of these are good, solid projects that have us very excited about our near term.
I want to talk about your revenue mix now, and many people might not know this, but Wheaton was formerly known as Silver Wheaton. So a large percentage of your revenues comes from silver. What's the breakdown between silver and gold?
Well, it has been about 35%, but with silver outperforming gold the way it is, it may be jumping up to about 40% of the revenue. We do have healthy silver production. In fact, I was just looking at a database yesterday, and I think we rank as about the 5th largest silver producer in the world. And so well over 20 million ounces of silver expected this year. With silver outperforming gold the way it has, and with stronger fundamentals behind silver, who knows? We may get back up to that 50% silver production, and I've had a few people argue that we should go back to the name Silver Wheaton. We do have some good silver exposure coming down the pipe, but I'll be honest, we see a lot more gold opportunities than we do silver, and so I don't think that'll ever happen. I think we'll continue to grow more in the gold space. But we do have Mineral Park coming on stream, strong silver producer. Copper World now, it's called Copper World, with Hudbay as a dominant silver producer. We have a bit of silver production coming in from Blackwater and of course El Domo and such. And so we do have some growth in the silver space, but we have much more growth in the gold space. And so even though silver is outperforming, I'm pretty confident that we'll probably stay in that 35 to 40% range of total revenues from silver. So probably I would argue by far the lowest cost base in the silver space. And so being 5th largest in terms of gross production, probably one of the most profitable silver companies in the space.
Randy, I want to move on now and just touch on your balance sheet. What's your cash position and how will you allocate cash in the coming year?
Well, at the end of Q3, we had about 1.2 billion cash on hand. We are generating this year. We should clear over $2 billion in free cash flow. And as I said, with the growth profile that we've got in 4 or 5 years, we'll be up over $3 billion a year in cash flow. So very, very strong cash flow. The construction financings that we have over the next 5 years total up to somewhere around $2.7 billion. And so we do have those commitments coming down, but that's the only commitment we have other than new acquisitions that we have in terms of going forward. And so that all combined. In fact, sorry, we just paid the HEMLO, so I think it's actually about 2.4 billion now because we just paid the $300 million HEMLO stream. And so we're in an excellent position. We also have a $2.5 billion revolver that's readily and immediately available for us if we ever need it. I don't think we'll ever issue shares again because our preference is to use debt to finance big growth. I am excited about the near term because I do think that there's some big copper builds coming. And those copper builds, building copper mines, the potential for the non-core precious metals byproduct, the gold byproduct, and even a bit of silver byproduct from those mines could result in multi-billion-dollar streams. We have seen streaming proposals go out in the $2.5 to $3 billion range here of late on some of these large-scale projects. And so we've got a good, strong balance sheet that I think is preparing itself for the age of multi-billion-dollar streams, which is not far down the road. And so really excited about helping the mining industry build big copper mines. Again, by purchasing the non-core precious metals byproduct from those mines through streaming agreements. Our cost of capital is incredibly attractive, and when you look at the value that we deliver for that precious metal byproduct from those copper mines, it's really tough to ignore us as a financing mechanism to help get those mines built. So I'm really excited about that opportunity over the next few years.
And do you think, and so you're expecting more activity on the copper side, but is this because of where copper is and it's trading at or near all-time highs?
Yeah, it's at or near all-time highs, but I still think there's another leg up for copper. When I look at the demand fundamentals and then where supply is coming from, there is going to be a shortfall that's going to have to drive developments. And so I do think that because most of these large-scale copper projects are 5 to 10 to 15 billion dollars in terms of builds, or multi billions of dollars, that it's going to take a good, strong, stable price platform for companies to make the decision to commit that capital in terms of a build. And I just don't, even though we're at near record highs, I think it needs a little bit more. And so give it a couple of years, and I think we'll start to see those commitments coming down the pipe.
Randy, as we wrap up, what can shareholders and investors expect in terms of news flow from Wheaton Precious Metals in the first half of 2026?
Well, we're still very active on the corporate development front, still looking at a lot of new opportunities with record gold, silver, and now copper prices. There's a lot of companies moving forward with either starting up new mines or expanding existing operations, and typically that needs capital. And so if there's outside capital needed, we'll be in there having a look at it to see. And we are selective about how we invest. We are very, very defensive. We focus on good, strong security and parent guarantees, unlike some of our peers who take greater risks on that front. Our promise to our shareholders is very, very low risk, very, very profitable precious metals production, good, strong growth in that space, and high quality asset base. Because we invest dominantly in the base metal space, we have extensive, expansive reserves and resources. And so our objective at Wheaton has always been to be the foundation investment in anyone's gold portfolio. Everyone should have some gold in their investment portfolio, especially in today's world. Today's times, we're seeing lots of evidence that the sovereign wealth funds and the central banks of the world believe that. That doesn't end there. It should be at everyone's portfolio. 10 to 15% is probably a good minimum. Wheaton should be that foundation investment in there. We're never going to make you look bad. Our costs are limited. Our risks are limited. Very, very low risk, very, very high margin precious metals production. That's what we're going to continue to deliver.
Well, I always like to finish on a strong note, and I think you just delivered there. So once again, I want to thank you very much for spending time with us today and sharing the Wheaton story, and look forward to seeing you in 2026.
Always enjoy it. Thank you.
Well, that concludes our virtual conference today, and I want to thank you for spending time with us. We have some amazing virtual conferences coming up in the weeks to come, focused on gold, silver, uranium, battery metals, and so much more. So be sure to subscribe to our channel, and you can also follow us on Spotify and Apple Podcast. Thank you so much for your support.